You know, we're often told that the secret to unlocking big financial insights is some huge complex algorithm, that it's all about fancy AI and machine learning. But what if that's not the whole story? What if the real key to success is something much more fundamental? Well, today we're going to uncover that powerful truth. And to guide us, we're going to lean on a piece of timeless wisdom from the brilliant physicist Richard Feynman. He said, "If it disagrees with experiment, it's wrong." It's so simple but so powerful. That idea is the bedrock of science, and as you're about to see, it's the key to smart financial analytics too. That's going to be our North Star today, evidence over everything. So here's our game plan. We'll start big with a universal method for solving pretty much any problem. Then we'll see how that applies to the real-world data science workflow. We'll get our hands dirty with a case study on credit risk, go on a hunt for better models, and then we'll uncover the real hero of our story. And to wrap it all up, we'll see why making mistakes is actually the secret to getting better.
All right, let's kick it off. Section 1, a method for solving problems. Now, before we even dream of touching machine learning or AI, we need a disciplined process. We need a framework for how we attack a question. And honestly, the best one out there, the most tried and true, is the scientific method.
It really just boils down to 4 simple but powerful steps. First, you have to ask a really specific question. Not, hey, why are we losing money? But something more like, why has our revenue growth in the Northeast region slowed over the last 2 quarters? Step 2, you take a guess. You form a hypothesis. Maybe it's a new competitor. Maybe it's a pricing issue. Third, you figure out what you'd expect to see in the data if your guess was actually right. And finally, this is the moment of truth, you compare what you expected to see with what the data actually says. This whole process turns a fuzzy business problem into a solvable mystery.
So that's the theory, right? But how does this all translate into the real world? Well, that brings us right to Section 2, the data science workflow. This is where we put that scientific method into practice, especially that last crucial step, confronting our ideas with cold, hard data. Now, check this out, because this might actually shock you. When you think about a data science project, where do you think most of the time is spent? It's not in the cool, sexy part building the models. Nope. A staggering 80%, 80, of the work is just preparing, cleaning, and making sense of the data. The actual analysis? That's often just a tiny 5% slice of the pie. The big takeaway here is that most of the heavy lifting happens way before a single algorithm is even run.
Okay, let's make all this theory feel a little more real. On to Section 3, our case study on corporate credit risk. We're going to apply this entire framework to a massive multi-trillion-dollar problem that affects pretty much everyone, from giant investment firms to regular employees.
So, what is corporate credit risk? Well, put simply, it's the chance that a company won't be able to pay its bills. And believe me, with trillions of dollars in corporate debt floating around the globe, the stakes for getting this right are incredibly high for investors, for suppliers, and sometimes even for taxpayers.
This example just makes the whole concept crystal clear. Let's compare 2 big chip makers from a few years back, Intel and AMD. First, let's look at leverage. That's basically how much a company relies on debt. Intel had super low leverage. Only 15% of its assets were funded by debt. And then there's coverage. Can it easily pay the interest on that debt? Whoa. Intel's income covered its interest payments 343 times over. Now, look at AMD. It was way more leveraged, and its income didn't even cover its interest payments once. Just looking at these 2 numbers, it's pretty obvious which company was the riskier bet, right? Okay, so this leads us right into our big experiment in Section 4, the search for better models. We're going to try and build a model to predict whether a company is investment grade, like Intel, or speculative grade, like AMD. The question is, can a fancier, more complex algorithm give us a better answer? Let's find out.
Okay, round 1 results are in. We tested 3 different models, a simple one called a logit, another called k-nearest neighbors, and a more complex one, a random forest. Now, to measure how well they did, we're using something called an F1 score. Just think of it as a grade for overall performance. And as you can see, the fancier models did give us a little bump, from about 77% up to almost 80%. It's an improvement, but it's not exactly the game changer we were hoping for.
And this is the turning point of our whole story. This is the big question. We've been so focused on tweaking the machine, trying to find a better algorithm, that we never stopped to ask, what if the model isn't the problem at all?
And that brings us to the climax of this whole explainer, Section 5, where we finally meet the real winner, better data.
Because the breakthrough we were looking for, yeah, it wasn't in the algorithm.
Now, just look at this. Seriously. We kept the exact same models, no changes there. But this time, we fed them a much higher quality set of data points, and the results are, well, they're staggering. The performance score for every single model jumps from the high 70s all the way into the high 80s. Just let that sink in for a second. The simplest model with better data absolutely crushed the most complex model with the original data.
And here it is. This is the single most important takeaway from our entire journey today. Successful machine learning is about data, not models. I'm going to say that again because it's that important. It is about the data, not the models. This is where you should be spending your time, your money, and your creative energy. Better data is what drives real, valuable breakthroughs.
But hold on, the process doesn't stop just because we got a better score. We're now entering our final section by asking a crucial question. What can our mistakes teach us? A core part of that scientific method is digging into where you went wrong, because honestly, that's often where the best learning happens.
So when we break down our model's mistakes, a really clear pattern emerges. Look, it gets the super safe, AAA-rated companies right every single time. 0 errors. But for the companies right on that fuzzy borderline, in the BBB category, our error rate skyrockets to 27%. The model is struggling most in those gray areas. So let's play detective and dig into one specific mistake, a company called Altel. On the surface, it looked pretty good. Strong coverage, low leverage, great. But when you look closer, you see its revenue stability was low. And here's the kicker. It was a tiny firm compared to other companies with a similar high rating. That was the hidden red flag. By figuring out why the model made an error, we uncovered a brand new important factor to consider: firm size.
And that's the whole point, right? The goal isn't just to get a high accuracy score on a dashboard. It's to understand why you're wrong. Because that understanding, that's what feeds the next round of improvements. It creates this amazing cycle where every mistake actually makes you smarter.
All right, so let's wrap this all up. What are the key takeaways? First, always start with a disciplined process, like the scientific method. Second, and this is the big one, remember that data quality is so much more important than model complexity. Better data just beats better algorithms, period. And finally, you have to systematically analyze your errors. That's how you really truly learn and get better over time.
And that leaves us with one final big question for you to think about. The next time you're facing a really complex analytical problem, what's your first instinct going to be? Are you going to immediately start searching for a better, more complex algorithm? Or are you going to go on the hunt for better data?